What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Happy Monday everybody. Last week, official local case numbers were quite low. This was either due to intense efforts at the local level to stamp out cases, or because it was a sensitive time with the Olympics and the numbers were massaged, or some combination of both. Whatever the reason, however, the state of affairs ended over the weekend with a new outbreak, which has resulted in a new city under strict lockdown. The city in question is the southwestern city of Baise, which borders Vietnam and has a population of about 3.6 million people. The city of Baise, that's Bai, third tone, not to be confused with Bai, second tone, is the first major Chinese city to be put under lockdown, strict lockdown, that is not majority Han. 80% of the city are made up of the Zhuang people, as well as other minorities. Today, Monday, local officials ordered residents in the city to stay home and avoid unnecessary travel in response to the discovery of a small outbreak over the weekend. The National Health Commission reported 37 domestically transmitted infections with confirmed symptoms for Sunday, up from 6 the day before that. Now remember, these are official cases, and with a zero cases policy, even the discovery of just one case will result in expensive and disruptive policy responses. The city has suspended non-essential businesses, public transport and school sessions, and delayed opening of ports of entry along the international border with Vietnam. Only essential workers are permitted to leave homes, and only when they hold special passes. Meanwhile, the Winter Olympic Games began on Friday. Dozens of athletes for the Games have already tested positive for COVID-19 and have been moved into isolation. However, these Games are operating in a closed loop, insulating them from the general public. Just a few hours ago, UK-based Reuters in an exclusive reported that on Monday, today, US officials called for quote-unquote concrete action from China to make good on its commitment to purchase $200 billion in additional US goods and services in 2020 and 2021, the last 2 years, under the Phase 1 trade deal signed during the Trump administration, which at the time brought a temporary halt to the US-China trade war. These statements from officials are coming just one day before the US government is due to release full-year trade data that many expect to show what we have already been saying for several months now on China Update, that China has failed by a large margin to meet its purchase obligations under the trade agreement. Last month, for example, we discussed a Peterson Institution for International Economics report, which found that through November 2021, China had only met about 60% of the trade deal's commitments. The Reuters piece wrote that officials said Washington was losing patience with Beijing, which had, quote, not shown real signs, end quote, in recent months that it would close the gap in the 2-year purchase commitments that expired at the end of last year, and that Washington was seeking, quote-unquote, concrete action, not, quote, talks for the sake of talking, end quote. The piece quoted one official as expressing, quote, because we inherited this deal, we engaged the People's Republic of China on its purchase commitment shortfalls, both to fight for US farmers, ranchers, and manufacturers, and give China the opportunity to follow through on its commitments. But our patience is wearing thin, end quote. Okay, quickly, just a few property sector updates. We need to continue to keep our eyes on the Evergrande Housing Crisis and its developments. The market has been closed for about a week and a half, but it opened back up today. The CSI 300 Index, a capitalization-weighted stock market index designed to replicate the performance of the top 300 stocks traded on the Shanghai Stock Exchange and the Shenzhen Stock Exchange, and which had fallen into a bear market just before the Chinese New Year period last month, rallied over 1.5% in trading today, Monday. As Bloomberg Hong Kong analysts observed today with this development, Chinese stocks had their worst January in years as, quote, worries about the weak economy and the property sector's debt woes outweighed Beijing's monetary easing, end quote. While global equities advanced when China was shut, quote, stocks on the mainland may struggle to keep up with any initial upward momentum given their weakening correlation with offshore markets unless confidence returns, end quote. However, bond markets were not as optimistic as their stock market sibling. According to credit traders, Chinese high-yield dollar bonds dropped at least 1% on the dollar bond market this morning. According to a statement to the Hong Kong Stock Exchange, Chinese property development company Country Garden Holdings Co. has further brought back 6 million of 4.75% senior notes due July of this year from the open market since January 18th. So this is over the last few weeks. Bloomberg reports that Country Garden will continue to monitor the market situation and make further buybacks. Since December 30th, the company has repurchased $30.1 million in bonds in total. And last up, let's look at several key economic, financial, and technology updates from the last few days in China. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. The services sector joins manufacturing and consumption as seeing a disappointing start to 2022. Activity in China's services sector in January expanded at the slowest pace in 5 months. The Caixin Market Services Purchasing Managers Index (PMI) dropped to 51.4 in January, the lowest since August, from 53.1 in December. We remember last week that China also saw a contraction in manufacturing activity based on the Caixin China Manufacturing PMI, which fell to 49.1 in January. Analysts point out that China's central bank has already started cutting interest rates and pumping more cash into the financial system to bring borrowing costs down, and further easing steps are expected in coming weeks. A senior economist at Caixin Insight Group observed regarding the data, quote, "In December and January, the resurgence of COVID-19 in several regions, such as Xi'an and Beijing, forced local governments to tighten epidemic control measures, which restricted production, transportation, and sale of goods. This year, policymakers should make stability their focus. They should prioritize improvements to employment and optimize the structure of the economy." Now, this is a very politically correct statement, but it does hit some of the causes on the head when it comes to the slowdown in the economy. Meanwhile, the Ministry of Transportation and Communications expressed over the weekend that the number of passenger trips during China's Lunar New Year holiday this year is expected to have grown 31.7% from last year. Now, while this sounds good, it is still more than 30% lower than the pre-pandemic level in 2019, indicating that household consumer confidence is still relatively weak heading into the year of the tiger. According to a recent stock filing, the founder and CEO of e-commerce giant and major competitor to Alibaba, JD.com Inc., Richard Liu, will donate company shares worth about $2.3 billion to charity. The Hong Kong and US listed company did not give further details about what specific charity or charities would receive the donations. Mr. Liu will also still remain the largest single shareholder of the company. Analysts were quick to point out that the donation may not be entirely motivated by charitable intentions, however. For example, analysts with Chinese financial media outlet Caixin observed, quote, "The tycoon is the latest Chinese tech entrepreneur to make a huge donation as Beijing tightens oversight of the technology sector and calls for common prosperity to narrow the wealth gap." End quote. That is to say, the billion-dollar donation may well be as much a political move as a charitable one. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.